So guys, welcome to VRD Nation. Through this channel, we are trying to educate our fellow investors and traders on every topic that pertains to investing and trading using real life examples, case studies, real life trades, animations, right? So we're trying everything that we can to make things simple. So if you're here for the first time, you're hearing me for the first time, do not forget to subscribe. So today we're going to learn a very interesting topic of stock market bubbles. Now, as we know that stock market is about business and finance, but it is also about people, right? Because ultimately it is we, the people, who decide the fair value of any stock using the forces of demand and supply. But being humans also mean that we are vulnerable to being emotional and irrational. And anyone who knows about the stock market knows very well how greed and fear overpower human judgment. So for ages, researchers have been studying the impact of human behavior, behavioral psychology on stock market, and some of them have come up with some really great insights. And one such interesting model was proposed by a researcher named Jean Paul, who tried to analyze how stock market bubbles form. Now the beauty of this model is that it can be summarized in a very simple chart. So let's try to understand this chart, right? So the x-axis is the time and the y-axis is the valuation, right? So valuation basically means the price that we as investors are willing to pay for all the stocks in the stock market combined. Now this dotted line right here shows the ideal valuation of the stock market over time. And as you can see that it is slowly inching up. Now the reason it is going up is of course because companies in any growing economy, they will grow over time, and with their growth, their value should also go up. So if you are living in a perfectly rational world, this is how much we would be paying for the whole stock market at any point of time, right? So wouldn't life be easier if we just had to deal with one price all the time and not have to worry about market going up and down, right? But that's not how life works. Anyways, now it's time for us to plot the first phase of the market, which is also called the stealth phase, during which the market is in a depression. So this is the time when nobody wants to talk about the stock market, and everybody is afraid. They don't even want to look at their portfolio. They don't even want to think about buying anything because they just recently have burned their fingers in the stock market, right? But this is also the time when smart money sees long-term opportunities in the market. But the very nature of the smart money is that it will not make a lot of noise, right? So that is the reason why this is called as a stealth phase, where everything is happening very quietly, nobody knows what's going on. But this buying interest slowly drives the market up to a point when it is ready to take off. Then comes the awareness phase, during which big institutional investors start seeing opportunities in the market, so they start buying. But what you have to understand is that even though smart money and big institutional investors are investing, the overall sentiment of the market is still very bleak, very negative. So the ride on the upside is not going to be very smooth, right? So this is the time where, whenever there is a rally, there is a chance that the rally gets sold into. So there is at least one round of sell-off in the market. Now, what happens is that whenever there is a dip like this, a lot of traders who think that, this market is still in a bear phase and it's going to keep going down, they see this as an opportunity to create fresh short positions. But what they don't realize is that the context of the market has changed. It is actually now getting into the bull market phase, and that is why the traders are said to be getting into a bear trap where their shorts get trapped and they have to eventually incur a loss. And that is when we get into the third phase of the stock market, that is the mania phase. Now what happens during this phase is that for the past two phases, the market slowly has been moving up, and that grabs the attention of the media. So media means TV, newspapers, and of course people on social media, right? Now, as you guys know that media is the biggest cheerleader for the stock market, right? There are hundreds and thousands of media pundits that will come out of the woodwork, and then they start predicting the levels that, this is a bull market rally. We're going to go up 20%, 30, 40, 50%. So everybody, comes up with their own idea of how much the market can go. But what that does is that excites retail investors like you and me to get more enthusiastic about the market, right? So the negative sentiment that we all had in the first phase, that slowly goes away, and now we start to get a little bit more excited every day about the prospects of the stock market. And it doesn't take very long for this enthusiasm to turn into greed, because at this stage this is almost like a god-like feeling that we begin to have, because every stock, every index that we are touching, everything that we are buying basically goes up 5-10% in the next few days or weeks. So we start to feel delusional And any rational question about the valuations is answered by a very simple phrase that this is a new paradigm shift in the market, right? So that's another fancy way of saying that the market will never come down. But this is the time when we hit the peak of the cycle, because some of the smart investors and the institutions who entered early, they slowly start to take their exit, which causes the market to correct a bit. But remember, the irrational exuberance that we all are feeling, that will not go away easily, right? So most of us are in denial at that point of time. Even if there is a fall, we will just say that, oh no, this is just a correction. It's just a great investment opportunity. And that is the advice that we give everybody else. And those who follow the advice and buy the dip, for some time they will get the feeling that yes, market has gone back up, we are going back to normal. But that stays only for a bit, because the market starts to fall and all that greed, all that delusion, all that enthusiasm fades away. And instead we start feeling fear. And when that fear reaches the point of psychosis, the market starts to capitulate on the downside. And that is where people start to give up, they start to sell their stocks, and they don't want to do anything from the stock market because they have again burnt their fingers. And that is a phase where people start to feel despair, right? So this is the phase which we call as the blow off phase. And if you remember, guys, this is exactly where we started back in the stealth phase, right? So where everybody was despair, and then again the smart money sees the opportunity to buy stocks at a valuation which is below their ideal valuation. So that is the big picture, guys. I hope that at least you got a good sense of how different players look at the market from different points of view. Especially the retail traders who are very much prone to excitement and fear and greed. How do they get trapped, and how do they incur losses because of the stock market cycle? So I hope that you will use some of this learning in your own investing and trading journey and hopefully benefit from it.